Hello and welcome to today's Housing Association annual update session, focusing on all things year end. I'm Hugh Swainson. I'm a partner from Buzzcocks charity and not-for-profit team. I'm delighted to be joined today by Edward Finch, who's also a partner within Buzzcocks charity and not-for-profit team, and Matt Hyrikachuk, who's also an associate director within the same team. The agenda for today, I'm going to be focusing first on an audit and accounting update, looking at the new things at the moment and coming up from a financial reporting perspective and from an audit perspective. Edward Finch is going to focus on the current sector developments and how some of those things may impact year-end and audits. And then Matt's going to look more detail at some of the key audit considerations. If we have time, we'll have a few questions and answers at the end of the session, but if we don't get too much time for that, we'll be able to email on any answers to questions that are raised after the session. So just some initial bit of virtual housekeeping. All participants today will have their microphones and videos off, but if you would like to participate, please do use the Q&A button, and you can ask any questions throughout the session on that, which, as I say, we'll either get to at the end of the session or email through if we don't get around to it then. The session will be recorded and the slides and the recording will be made available after the session. So let's get started, and just going straight to my first slide, looking at the reporting framework that you're going to have to be dealing with for this year's year end. The really good news here is that there's no key changes in the reporting framework for this year. So really we're dealing with the same requirements as we were for 22-23. That's particularly good news given that, as you'll see as we go through the session, the theme of recent times and unfortunately for the future has been increased regulation. So there is more and more to do in terms of all types of regulation, but including in terms of financial reporting and audit regulation in particular. But fortunately this year we have a little bit of stability going into the year end, which is good news. So therefore the things listed on this slide will be hopefully familiar to you from the previous year. Housing associations will be almost all reporting in line with Financial Reporting Standard 102, the underlying UK financial reporting framework. They will then be applying the housing SORP, which takes FRS 102 and gives specific guidance for how to report in the housing sector and how to interpret things for the housing sector. You have the accounting direction, which adds specific disclosures into the notes to the accounts in particular that are not in FRS 102 but are required for housing associations. So those will be the key things that everyone will need to focus on in preparing their financial statements for this year. There may be other additional requirements that particular housing associations have. So for example, if you're an incorporated association under the Companies Act, you'll have Companies Act disclosures, and if you're a large classified as a large company, you'll have streamlined energy and carbon reporting requirements in the front end of the accounts. And of course, if you're a group, you may have particular reporting requirements for some of the group entities, whether those are done under, for example, Section 1A of FRS 102 or full FRS 102, or others may have charitable entities that report under the charity SORP within their group. But ultimately, none of those things have changed either, so you're under the same reporting requirements this year. And just remember, there are other resources out there, such as the model accounts, which are being published by Grant Thornton, but are sort of officially signposted through NHF, and which is a useful resource for housing associations, because, you know, let's face it, the reporting is very similar across the sector, and some of the model disclosures can therefore be very useful. So that's what we're looking at for this year end. Let's turn now on the next slide to what we're looking at for the future. And I suspect everyone now has heard about FRED 82, the Financial Reporting Exposure Draft, which has been released, which is basically setting out the proposed changes to the underlying financial reporting standard FRS 102. And these proposed changes, the context of them is really predominantly bringing alignment of UK financial reporting into line with some of the international financial reporting standards. This has been ongoing for quite some time now. So FRED 82 was published, and then subsequently there was a consultation on the proposed changes to FRS 102, and that consultation was completed all the way back in April. So lots of organisations responded to that consultation, and that was all publicly available and published, the responses to that consultation. And that included the Housing SORP working group and also other organisations such as Clarion Housing who responded to it. Their response, along with many others, really emphasised concerns over the timing of implementation of the new financial reporting standard, which was due to be implemented on 1st of January 2025, which would have impacted 31st of March 2026 year ends for housing associations, but presumably in response to some of those issues identified in the consultation, the implementation timetable has been now put back by 1 year. So the implementation date is now 1st of January 2026, which will really mean in practice for housing associations, you're looking at your 31st of March 2027 accounts being the first ones that are being reported under the new framework. So obviously we're now looking at 2024, you've got 25, 26 and then 27. So still seems some way off. So why was everyone concerned about the timing and implementation, given that it's still quite a long way away? There's a couple of key reasons for that. The first is that this is just the underlying financial reporting standard. That standard then has to get interpreted into the housing sector through the implementation of the housing SORP, and so that really can't begin in earnest and with the redrafting of it until the financial reporting standard 102 is finalised and published. We don't have an exact date for that publishing of the standard yet, but probably expected over this summer. And then it's going to take some time for that SORP to be drafted and then that to go through consultation before the final draft is then issued for use in the sector. The other thing is looking at the transitional arrangements, and these aren't entirely finalised at this stage, but potentially the implication is with the one of the biggest things that we'll come onto that's will be changing in the new updated standard is around operating leases and the treatment of those. And if you have to change the balance sheet on that, you could potentially have to change the comparatives. And if you're looking at 31st of March 27, comparatives to 31st of March 26, but then you've got the opening balances on those comparatives from 1st of April 2025, which then comes around a lot sooner than you think. But the transition is still to be confirmed, and so there is some talk of being able to update in the year rather than having to change all the comparative figures. But as I say, that's yet to be confirmed, as it's going to be an important factor. So as I say, from the housing SORP point of view, still a lot of work to be done on this once the full standard is published, and really that timeline for that's really going to be leading into that year-end process for people preparing in 2026 for the 2027 year-end. So what are the key changes coming out of FRED 82 and that we can expect to see in the update for FRS 102? Well, I'm sure people will have heard about lease accounting, and this is sort of alignment with IFRS 16. So we do have some sites of how this is already looking for those organisations that apply IFRS. But the general idea is that operating leases will come onto the balance sheet. So as I'm sure people know, the situation currently is if you have an operating lease rather than a finance lease, the costs of that operating lease just go through the statement of comprehensive income as the rentals occur, and then you disclose in the notes to the accounts your commitment under that operating lease for future payments. This will be a change where you bring the asset onto the balance sheet and then have a liability for those commitments also on your balance sheet. In terms of bringing the balance onto your balance sheet, it's considered the terminology as a sort of right of use asset. So say you were sort of had an operating lease for a building, you're not actually bringing in necessarily the full value of that building onto your balance sheet. All you're bringing in is the sort of essentially the level of asset that you get under the operating lease. So the way it's calculated is in line with the lease liability, and the way that the lease liability is calculated is by looking at your future operating lease commitments and then taking a discounted value for those operating lease commitments. So there's going to be two really key elements of determining the lease value. It's you're going to have to look at the discount rate that you're using for that operating lease, and also the term of the lease. And the term of the lease, as people may be familiar with operating leases, you often have an initial lease term and then a potential break clause and an extended period. And there'll be key accounting judgments and estimates in determining whether you will continue beyond those break clauses, which will affect the asset and liability values that go onto your balance sheet. So there will be a fair amount to think about for those with operating leases. It goes without saying the impact of this is very dependent on the volume of and value of operating leases that you have as an organisation. So this will be mixed, obviously, across the housing association sector. Most will have some operating leases, so this will have some accounting impact. So we'll take require some preparation and restatement of an update of figures in the financial statements, but obviously others will have more operating leases, and this could have a much bigger impact in terms of the look of the balance sheet and the way things go through the statement of comprehensive income, and then obviously then having more of an impact on things like loan covenants going forward. So that's the biggest item that everyone's focused on coming out of expected for FRS 102 update. There's lots of other things which I will briefly touch on, which are more points of sort of detail rather than sort of more fundamental changes like the lease accounting. So, for example, the definitions of assets and liabilities are sort of just slightly different in the proposed update, and there's questions been raised in the Housing SORP Working Party around this, and so examples include from the asset side, if you've got enhancements to buildings with the purpose of ESG or climate benefits, would that meet the definition of an asset? On the liabilities side, it's things like obligations for fire safety and decarbonisation. Will those meet the definition of a liability? So I think at this stage it's too early to say, well, that sort of will land, but it's to note that there will be other points of detail which could have an effect on the detailed accounting for the year end, which will require more preparation around this whole transition into the updated FRS 102 and updated SORP. It's also worth just being conscious that the SORP itself can make further clarifications and updates that are beyond FRS 102. So it's not just the fact that FRS 102 is being updated, the SORP itself is taking that opportunity to update as well, so can potentially sort of clarify things which may require certain housing associations that have taken judgments about things to change the treatment going forward. Revenue recognition is also one you may have heard of that's being updated. And there is a sort of fairly key change to how the guidance around how you recognise revenue is detailed in the update to the standard. So there's this 5-step approach now for recognising income. However, although the methodology and the 5-step approach is sort of newly described in the standard, the actual consequences of it in terms of how income is recognised is actually fairly limited. So we're not expecting an overhaul of how housing associations will recognise income coming out of this change to FRS 102. It's really just how it's sort of described in the methodology that's described in the standard being updated. There are things around the edges, such as again, the housing sort working group queried on things like insurance claims and getting more clarity, bringing more clarity in that area through this process. But the core of income recognition is not expected to change. So that's just a flavour of some of the key things in that we're expecting to see come through that will impact housing associations. But say where we're at now, FRS 102 isn't finalised and we don't have a SORP. So to some extent, the key thing is just to keep a watch on this and be aware that it will. You'll need to prepare for quite a bit of work when this does come through, because of the lease counting, various other changes that are coming through. I think one key thing to watch is timing in all of this, particularly the transitional arrangements and whether comparatives are going to need to be updated with the opening balances to comparatives. The other thing is just to be conscious with new leases. If you're entering significant new leases, is worth having more of an awareness of this kind of accounting, because it could have more accounting implications for you going forward when you're signing a big lease, and being aware of the impact on loan covenants. Obviously, this isn't unique to the housing sector. All organisations will have to deal with this, and banks will be very familiar with it. But nonetheless, you don't want to be caught out with implications for your loan covenants, and need to be prepared on that. So it's worth being conscious of that. So I think those are the things to watch out for now on that. On to my next and final slide. Just looking at the audit side. Again, good news in terms of audit regulation. There's no significant changes to audit requirements for 23-24, so good to have some stability in what we've got. But as I've said, there is this trend of increasing audit regulation, which has been quite significant in recent years and is continuing. So I'll flag up some of those points. I also wanted to highlight that obviously the big change for 22-23, which everyone would have had to go through last year, was on ISA 315 and ISA 240. So ISA 315 being around audit planning and risk, and ISA 240 being around fraud. And that had a big impact on the auditor's requiremements and what the auditor needs to document on their files in 22-23. Obviously, it wasn't a one-off, so that's continuing for 23-24. And whilst there's no further updates to that, I think particularly in terms of general IT controls, which was the big I suppose practical impact of some of the ISA 315 changes, auditors will have learned from having their first time of applying those significantly enhanced standards and what they're seeing come across from the sector. And we also would have seen quality control reviews by regulators coming through when they're doing their first reviews of those audits under those standards. So we can expect sort of further learnings and refinements to come through as that's all integrated into the system. But essentially, it is the same requirements as last year. So auditors really need to get a grasp of general IT controls across any system that carries financial data. So obviously the finance system, but all the elements of it, whether it's the sort of purchase ordering or the rent ledgers and fixed asset register, those side of things, the HR and payroll systems, banking systems, but also how housing associations do their projections is quite critical to understand. A lot will use software for that and how that operates, and if some are doing in Excel, that's got its own risk attached. So a lot of focus on those systems and things like general network controls, access to those systems, how systems are reconcile controls, talk to each other, automation, those kind of issues are still going to be an important focus. And it's a planning standard, so a lot of focus on the planning stage of that are feeding into this year's audits again. But the good news is that a lot of work was done last year on all of this, so that can be used at least as a starting point for the audit process this year. It's also worth thinking about fraud and the developments in this area, and I suppose linking the two together. Cyber risk is only continuing to increase. So I think we're at a stage now where everyone's familiar with the risk of phishing emails and change of bank details and the need to have multi-factor authentication, those kind of things. But nonetheless, we are seeing this still high on risk registers. The risk still increasing. We are still seeing incidents get through in this area, so it will be a continued focus, and I think it continues to be an emerging area. So, for example, we're seeing with artificial intelligence, organisations starting to engage more in that area about what that can offer in terms of organizational efficiencies or analytical tools coming out of that. But equally, it's likely to increase audit risk, fraud risk over time from cyber fraud. So the sort of organizational leadership and governance around these kind of areas on cyber is really key, and it's only going to continue to be an area of risk and audit focus going forward. ISO 600, just to briefly mention, this is an auditing standard around group audits. Same for this current year. It's going to be updated for the 24-25 year end audits, and there's various updates to this will affect how auditors will document their work on groups. So if you're obviously a housing association that has a group structure, I think really just to say on this, the biggest impact will be that if you're using different auditors for certain components of the group, which most housing associations aren't, they're having one auditor for the whole group. But just to flag up, if you are in that situation, there's much more sort of in terms of the group auditor's responsibility for the overall group audit and communicating aspects and responding to risk across the entire group. So that's coming in. Revised ethical standard. There's a revision to the ethical standard that looks at things like safeguarding auditors' independence, that kind of thing, coming in this year, that will be effective at the end of 2024. So again, really more for thinking of going forward. This isn't too much of an overhaul or a fundamental change, but it is again reflecting this increased regulation and increased focus on the external auditor's role as external scrutiny and independent external scrutiny, rather than getting involved necessarily in too many other areas or services. So, for example, they've tightened up the definitions around internal audit following the prohibition of external auditors doing internal audit. They've tightened up the definitions so that make sure external auditors aren't doing things that could be open to interpretation in terms of what is. And then finally from me, just looking at ESG. So for housing associations, obviously decarbonisation has been a big feature, and people are very focused on that currently, and we're seeing that coming through in the financial reporting in front end of the accounts a lot already. But in terms of actual financial reporting requirements, they're very few at the moment, and really it's only those incorporated housing associations that are of a certain size that have to report under streamlined energy and carbon reporting rules that are giving detailed reporting in this area. So a lot of this is going on at sort of a voluntary level. Obviously, stakeholders are becoming increasingly interested in this area, whether that's just sort of general public or lenders giving ESG linked loans, that kind of thing, but a lot more interest in this area. And we've seen this sustainability reporting standard for social housing, which is sort of a voluntary bit of guidance that was issued back in 2022, encouraging this sort of tracking of data on environmental sustainability, those areas, and reporting that in annual reports. So more and more coming out on that. The latest update in this area is that from an international point of view, IFRS S1 and S2 have been released. Just briefly, what they cover is one on S2 is more on sort of climate implications and considering that in your annual report, and S1's more about more general sustainability considerations and talking about things like sort of risk in these areas and outlook in the annual report. But these don't apply to UK organisations. It's very sort of new, so standard setters in the UK are still considering, you know, what if any response is going to be coming from the UK reporting in terms of these standards. So we don't have anything concrete yet on this, but there's a clear trend towards increased reporting in this area. So it seems unlikely that the sector is going to be able to continue with this position where it's fairly light touch in terms of regulatory requirements around reporting in this area. And so I think sort of focusing on this area and sort of the collection of data internally as an organisation and being ready for future reporting requirements is probably advisable at the moment. But that's everything from me. So now I'm going to hand over to Eddie to give more of a developments and risk update. Thank you.
Great, thanks a lot, Hugh. And this little section will really just act as a bit of a bridge between what Hugh said and some of the more detailed areas around audit that Matt's going to look at. But what I'd like to do is just draw out some of the things that have come out in recent announcements and developments, particularly in as far as they might affect the audit, consideration of certain risks around issues that could lead to you thinking about impairment or about your future viability in your going concern review, etc., which is the kind of stuff that Matt's going to pick up in a bit more detail. Moving on to the first slide. So some of the things that came out of the regulator's risk profile review in November last year that impact on the way we think about things for accounting. A lot of these are really just continuations of themes that have been around for a while, and there were also some themes that Hugh's just been going into in a bit of detail around risks around cyber and climate and things like that, which were also in the report, so I won't be repeating those. So there was one theme around the sort of competing pressures and tensions that you're all facing. So the squeeze on income, the pressures on expenditure from inflation and other sort of regulatory reasons, the increasing amount of catching up on certain types of sort of updating and climate commitments, all those kind of things that are just creating sometimes difficult to reconcile tensions and pressures for organisations. So strategic prioritisation and choices are a theme that the regulator emphasised a lot through their review. The rent cap, not as big a problem this time, although obviously the impact of having rents capped in the previous period will compound into the rents that you can carry on raising into the future. Costs and labour scarcity were highlighted last time and continue to be issues. And also, though, the demand for additional housing capacity, all of the political parties, and right at the end, we'll just have a think about what might happen if we have a change of government, but all of the parties are, in principle at least, pushing for more housing, and associations are one of the sort of main perceived sources of that. There's lots of different things that might be impacting on your ability to stay within your covenants, but particularly interest cover was flagged in the review. The overall interest cover of the sector as a whole had dipped down to only just over 100, I think, but it was felt that that's probably bottoming out in this current financial period. But for anybody who might need to get some kind of relaxation of covenants in place, as ever, it's important to get that in place before year end for balance sheet purposes. The regulator highlighted specific risks around the diversification in the sector, and that the risks around more commercial development have got greater. This links into some of the later points around the pressures on the broader construction sector and the increased risks in that industry generally. So those are the kind of tensions I think that have been there for a number of years, and I'm trying to stop people writing about the current economic climate these days, because we've had difficult economic climates for a number of reasons for 15 or more years at the moment. But the pressures do change from year to year, and the emphasis in what you'll need to think about maybe is slightly different this time around to previously. There are issues for borrowing. Some of the aspects of maybe your people's grading slipping because of difficulty keeping up with covenants and that kind of stuff. The forward forecast looking maybe less certain. There is a feeling that interest rates will ease and that might take away some of the pressures, but recent press coverage of interest rate decisions mean that maybe the speed at which rates will ease off and the amount by which that they'll settle at, we've got a bit more of a pessimistic view of just at the moment. And then another area that the regulator talked about was the sort of increasing use of maybe alternative sources of finance, so private sources maybe as opposed to institutional, but the different risks that come from that. And if you've got those kind of things going on, then they do create a different risk profile when you're thinking about your financial future. A particular area that the regulator picked up on was counterparty risk, and there are a lot of different counterparties that associations have. One that was particularly highlighted was construction and other commercial partners, and the regulator highlighted that the insolvency rate in the construction sector is the highest particular sector out there. Which clearly means that sort of making sure you've got a good portfolio of partners for your regular work, and that you do your due diligence on partners for projects, etc., is as important as ever, but that the risks are maybe slightly higher. Local authorities as a counterparty, there was some commentary around supported housing and those kind of things. Anything non-statutory that's funded by a local authority is fairly clearly at risk, with so many of them suffering their own financial difficulties and having to cut back on things that they would like to but can't afford to support anymore. And then the other counterparty that's obviously one of your main stakeholders is your tenants collectively as a group, and there's an ongoing concern around their ability to bear what the rents they're currently paying, let alone increases with the cost of living pressures on everybody at the moment. And then the last area I'll draw out from that review is there was a theme around operational expectations. The consumer standards, which I'll look at in a second separately, but they bring in issues around stock condition and monitoring that, and the new tenant satisfaction measures standard as well. The proactive regulation with the new grading coming in for larger associations, the C grade alongside the economic ones. And then the health and safety issues that have been massively well publicised and have led to all sorts of conversations within the sector and beyond. So cladding is still an issue that's rumbling on for a lot of organisations that are affected by it in their stock. RAC, probably not such a big issue for the housing sector generally, but for some specific associations is something that the regulator is obviously keen people rule out as a specific problem for their own body. So those were the things in the sector profile generally that I think were drawn out that probably do lead to thinking about things like provisions and impairment and the kind of things that might impact on accounting. And then on the next slide, just a sort of little reminder of what's been happening with the bringing in of the consumer standards. So this has all come from the Regulation Act and enabled the regulator to move from the sort of previously reactive approach, so only being able to intervene if things were drawn to their attention, to a proactive approach, similar to the way that the economic standards have been regulated for a while. The new standards mostly reflect sort of updating and rebadging of previous standards, so that's summarised there. The one that did come in as a brand new standard from April last year, the tenant satisfaction measure standard, you should have all been collecting your data and be ready to be reporting that in spring this year. There's another standard in consultation which won't come around until April 25, but those standards as a body have really just sort of consolidated this as a strand of the kind of thing that you're expected to be accountable for. And then just moving on to the final slide. Well, it's not the final, might be the final, we'll find out. The implications of those standards and the change in regulation, In some ways, and Matt will cover this in a lot more detail, there's probably not that big a change in the issues around provisions and liabilities for sort of state of repair, etc. Although the processes you might be going through to make sure you can comply with the standards and demonstrate that your data's up to scratch might be uncovering issues that you weren't maybe as aware of in the past. So you might be finding things that the way you consider them will be the same, but the level of data you've got to make decisions on might be greater. The definitions that you're working to broadly similar to that which we've had before, and the legal developments have been pretty well trailed over time. However, I think a key thing here is that the public profile of the risks, so things like mold and other issues, have been raised in the public profile. So the volume of complaints and the intensity with which people will be expecting you to follow up complaints will have increased. So all of the risks around this are probably increasing in practice. And I think just in summary for these standards, the sort of costs of making sure your data requirements, etc., your data management rather, is up to scratch, that you've got the right governance and transparency in place, and the logistics of just ensuring that you've got systems and that they're up to date and etc. Is one of those competing pressures that I was talking about at the beginning. One of the things that is competing for your attention and is just as important as maybe lots of the other things you might be doing otherwise. And then moving on to the next slide. Some of the things that might affect the grading in future, some of the things you need to think about and how they may flow back into thinking about accounting and audit risks. In terms of your risk management framework, the consumer standards, you'll need to be able to demonstrate that there's enough emphasis on those kind of issues within your general risk management, your risk assessment, that it gets the same kind of profile and prioritization, that you're able to show the ability to escalate and to prioritize things that can turn into severe problems over maybe the more routine stuff. There might be question marks around board expertise and advisory input. So now there's the greater emphasis on this particular area, making sure that either around the board table or bringing in as needed, you've got the right kind of expertise to make sure you're on top of these issues and that your systems and processes are sufficient. And also being able to demonstrate what action you've taken. So where your own risk assessment or external reviews of compliance have addressed highlighted gaps in what you're doing, what you're actually doing to get up to standard where those gaps are identified. And a lot of this will rely on something that's been a massive theme across many areas in recent years, that the whole issue of data quality, of making sure you've got the right processes and systems to capture the right data, that you're confident that it is being recorded properly, that it's accurate, that it's complete, and all of those things that are just basic bread and butter, making sure you've got a body of data, but then your policies around data governance, data security, data protection, etc., to make sure that you're actually holding all that information properly as well. And for all of this stuff, really the board is going to need assurance that when it's making statements in its public reporting and submissions to regulator and getting ready for its assessments, etc., that it's got assurance that these things are being done properly, so that internal audit or other assurance providers can give the right input to the boards. And it might be a question around whether current providers of services already have the expertise to give assurance over these systems, or whether maybe different suppliers and different sources of assurance could be sought. And I'm sure our brethren on the internal audit side probably already have products ready and that they're waving under your noses. But I think for boards, it'll be important to make sure you do know how you can be sure that these new processes have been properly put in place. So this is just really it's probably frivolous speculation, really, but at the moment, as ever, there's always a bit of political risk. There's always the issues of government policy and whether trailed intentions will turn into concrete policies and what that'll mean in practice for associations. But I think with a possible change of government in the next year and housing having been put front and centre of their stated policies, we might expect it to be a sort of first 100 days kind of issue where change might happen quite quickly. The consultations around, for example, easing off some of the planning regulations have apparently already taken place, and they've got plans ready to roll already on that. The commitment to build 1.5 million homes is a pretty big call, and I know current government has made similar commitments in the past that maybe haven't materialised, but there's a potential for a lot of new activity to be happening in different ways to the ways it's happened in the past. There are question marks around the role of associations and local authorities perhaps in housing, as an incoming government might have some kind of hankering to move back towards local authorities being more involved in some of this than in recent decades. There'll be more coordination required. There's likely to be an emphasis on targets and actually maybe reintroducing specific housing targets for areas to meet. I've mentioned the planning changes. They might be quite significant. They're more likely to be targeted at particular areas and particular types of land that might be redeveloped, but the speed of planning and being able to move developments on might get better. And then an emphasis generally, I would expect to come through on an emphasis of public-private partnerships, bearing in mind that associations fall technically on the sort of private side, but in funding terms on the public side of that, might lead to slightly different relationships needing to be formed and managed into the future. And just as a final thought, all of that obviously leads to just a greater degree of forecasting uncertainty, which makes those impairment judgments and future forecasting for going concern and viability, etc., just that little bit more difficult. So on that happy note, I'll hand over to Matt, who's going to look at some of those specific issues around year-end reporting and the way uncertainty might affect how you think about those.
Great. So just in this final section, we're going to talk through in a bit more detail some of the practical elements from an audit perspective, in particular any areas where there's been a slight shift in either the accounting treatment, or it might be new areas which you might not previously have had to account for before, or there might be just a bit of a shift in our audit focus. So the areas we're going to take a look at this year are going to be sort of how to account for a pension surplus on a defined benefit scheme. So if you're in that position at the year end when you've got a net surplus position, how to account for that. A reminder around some of the sort of considerations around determining an appropriate discount rate in impairment calculations when you're calculating your discounted value for your assets. Minor update on provisions linking back to what Eddie was discussing earlier, and just a little bit more around what auditors are likely to ask for around loan covenant monitoring at the year end and financial forecasting and that side as well. So just moving on to the next slide. So the first area we're going to look at here is around that pension asset capping. So this is really considering the value of any cap to place on your defined benefit asset on the balance sheet. So just talking a bit really here around how this has come about, the accounting requirements and how to determine and apply the treatments that's most appropriate to your scenario. So when we're talking here about pension assets, this is where we're going to be talking about where, as we'll see on the next slide, the actuarially determined value of the assets in the scheme exceed the actuarial value of the associated liabilities. So when this is the case, there's going to be a net surplus in the scheme at the year end. So just moving on a couple of slides here, you'll see from the graph here that historically this is not, the table, that historically this hasn't been a common situation to find yourself in. So most associations will have been used to having deficit positions on your balance sheet at the year end, and often you'll have had to find yourself explaining how these movements have resulted in your year end balance sheet being adversely impacted by that net liability sitting there, which is unlikely to materialize in the short to mid-term. However, you'll see on this table there's been that big shift in 2022, and that really arose from that increase in one of the key principal actuarial assumptions applied to the scheme's valuations, which is that discount rate that you're seeing there. So you can really see from this table that shows the assessment of the sort of typical rates applied from December 2021 to December 2023, roughly a 3% increase between 2021 and 2022. And in the past 12 months, that's only slightly reduced. So this has increased the actuarial value within the schemes. And at 31st of March 23, it wasn't uncommon to be in a surplus position for associations, and it's possible other associations at 31st of March 2024 who previously were in a slight liability position could also have been dragged into a surplus position, and those who were in a previous surplus position will remain in there at 31st of March 2024, obviously subject to any changes over the next month. So we've also heard of some associations negotiating to leave defined benefit pension schemes over the past sort of 12 months or so, and some of those have also actually received refunds. So when we come on to the next slide here, which talks around the underlying FRS 102 requirements, one of that demonstration of being able to recover a surplus is a really key element in determining whether or not you can recognise a surplus on your balance sheet here. So what the accounting standard says here is that you can only recognise a surplus to the extent to which it's deemed recoverable, either through reductions in contributions or refunds from the plan. So if as an association you consider that to be the case, a surplus could be recognised, but only to the extent that recoverability of that can be demonstrated. And demonstrating that recoverability is really the most challenging thing within this. So coming on to the next slide, this gives a bit of a bit more detail as to how you may be able to, or some of the challenges you may have in demonstrating that recoverability. So really it's going to be sort of less likely that you can demonstrate any recoverability. For example, if your employee contracts, for example, state that they will be members of a specific pension scheme, if sort of post-year end movements would adversely impact evaluation, but really sort of one of the most important things in this is what it says within your actual scheme rules. So if the scheme rules don't clearly say any surpluses would be recoverable by the employer, it can be really difficult to demonstrate that recoverability. So that's really the key areas that sort of this crux is on. If you do manage to get to the point where you consider amount to be recoverable, from an accounting perspective, there's one extra step to fit in, which is to ensure that your actuarial report also includes consideration of what's known as a asset ceiling. So that will help include consideration as to what elements may or may not be recoverable within that. But because of the potential accounting treatments available, you'll likely be also asked this in advance of receiving any actuarial reports by your actuary. So if they don't include that calculation of an asset ceiling by standard, you'll likely be offered it as an option around year end as well. So just coming on to the next slide, the final slide on the pension side of things, this just notes some of the accounting treatments. So if it's your first year having a surplus, what you'll see here is your balance sheet value of your liability. If you're going to cap it and not recognise any asset would be nil. Your offsetting entry going against the actuarial gain that you'd see there. If you had an asset both sort of last year and this year, you still post your service and interest cost journals as normal, but there'd also be an offsetting actuarial movement against those journals. And then if you're recognising an asset in total, the accounting would be the same as if recognising a liability, but do remember those considerations around an asset ceiling within that. So really just in terms of how to prepare for this, this is an area you probably want to discuss with your auditors in advance of the year end, just to talk through your proposed approach and whether or not you perceive it to be the case that you could recognise a surplus within that. Either way, they're also likely to suggest some additional areas where they might want to see some additional disclosure in the accounts. This is the kind of area where you might want a little bit more discussion narrative within your sort of accounting policy for pensions, and also within your pensions note as well. Moving on to the next slide and the next area. So this area is all relating to sort of impairment assessment, and in particular, just focusing on one of those sort of key areas that's come up over the last couple of years, which is how to determine the right discount rate around this. So this is really relevant when your sort of impairment indicators have identified a potential impairment, and now you're at the stage where you're looking to calculate the discounted value of those associated assets. So one of the key judgmental inputs which really drives that value, which you're going to get out of that assessment, is the discount rate which is going to be used. So on this next slide, it just gives a bit of an indication of one of the key really factors that's driving that, and that's the long-term cost of capital. So this graph here just shows the SONIA rate over the last 4 years. So you'll be very aware that it's risen quite significantly in that period and currently just above sort of 5%. So the underlying accounting standards, when it talks around sort of discounting for impairment, does reference the base rate as being one possible rate which could be applied. But ultimately, this again, it's an area of judgment. It's an area where there is a bit of uncertainty, and it's really a case of the association needing to determine what rate's best to apply, and that's going to depend on the circumstances of your own association. So on the next slide here, we're just giving some insight into some of the key considerations that will form part of that assessment. So when you're determining a figure to use, you'd want to really be considering the circumstances that are specific to you, and the cost of your capital and the rate that you're using for any calculation should really reflect those circumstances. So this is going to be one of those judgments that your auditor will look at. So it's important to be realistic in determining that rate. So some of the areas that are going to affect the rate that you're going to use are going to be, for example, the interest rates attached to your current borrowing. So if your current borrowing's at higher interest rates, your long-term cost of capital is likely to be higher. Whether or not you're due to take out any new borrowing and the likely rate of that on that new borrowing and how that might impact your capital cost, and also the period over which you're discounting. So this again, it's another one of those areas where you want to speak to your auditors in advance of the year end just to discuss your thinkings at that point, so that you're not having to rerun sort of calculations at a later date, and really help ensure that sort of year end process for establishing any impairments a nice and smooth one. We've just got a couple more slides to go. So this penultimate one is just coming back to what Eddie was talking about around sort of consideration of any sort of legal disrepair and any provisions required around that. So this is something that will always come up as within the audit as part of your considerations on your year-end sort of accruals for provisions, and ensuring that considerations being given to whether there's any sort of legal or constructive obligation there for costs in respect for any properties that are in a case of sort of legal disrepair. So Eddie had mentioned there'd been slight updates to guidance this year as a result of those changes to regulatory standards, and there's also the ongoing sort of consultation that's due to close on the 5th of March. However, really from a sort of stand back perspective, for the majority of associations, all this is really unlikely to have a material impact on year-end positions. There may just be some slight changes to the exact points at which a liability could crystallise, but it's likely to be related to sort of smaller level estimates from that perspective. At a larger scale, it's unlikely that there's going to be an issue at individual properties, which could be material, but it's an opportunity actually this to just get to a point where you're knowing whether you're able to gather that data in a sort of timely and accurate manner for sort of future compliance reviews from this perspective. So this is an opportunity to see, have you got that data available? Have you got an estimate of what the sort of costs associated with it would be likely to be, and that's really the sort of the mechanism that this gives a opportunity to test around the year end. So it's not necessarily a material change from a financial point of view, but it's a good opportunity to sort of test in proof whether or not those processes that underpin everything on that side are working. Just turning on to the final slide then. So this is just a bit of an update on loan covenant monitoring and forecasting. So this is always going to be a standing point on any audit, and Eddie had mentioned as well some of those big changes, well, not necessarily changes, but changes to the risk profile within the sector that are impacting those. So this is just helping sort of inform you as what we're going to be looking at from auditors from this perspective. So whenever we're looking at these budgets and forecasts, our sort of primary period of focus, the one that we're really looking at is that going concern period. While formally that's 12 months from the date of approval, realistically we tend to look at least sort of 18 to 24 months ahead in case there's any projected items falling just outside of that window. So the real reason we're interested in this period in particular in relation to sort of loan covenant monitoring is that in theory any breach of covenant could potentially have an impact at the timing of which any borrowings become repayable, and therefore there could be a theoretical liquidity risk associated with that. In terms of what's changed this year around that, our concerns really are just similar to the regulator in that loan covenants are generally looking tighter at the moment. We do expect, therefore, the amount of modelling and scenario planning to reflect the increase in the level of associated risk. So this is one of the reasons from a regulatory perspective that at times you see governance ratings reduce at the same time as financial viability ratings, because there's not necessarily that link between the two until there becomes some kind of initial prompt for that. So in terms of what you're likely to have to prepare for year end, this is a bit of a sort of typical auditor answer, but there's not necessarily one exact scenario that we'd expect you to plan for. What we expect is really the level of your planning to be proportional to your level of risk, but generally we'd like to see sort of a scenario plan where it sort of breaks your rule covenants, and then working backwards from there, a range of scenarios that are proportional to the level of risk to which that sort of covenant breaking scenario suggests you might be exposed to. So this is another one of those areas where the sort of best way to prepare is just to have those discussions with your auditor up front. So to assess that initial sort of suggestion of the level of risk to which your association's exposed to potentially, and then what they're likely to want to see as a result of that, both from a sort of projections side of things and also to confirm some of those assumptions within those projections in terms of sort of values of amounts, and also in terms of sort of the sensitivity to timing in relation to some of the points Eddie mentioned in relation to some of the challenges that there's been within the sector in getting work completed in time with the labour shortages in the sector. So really, in terms of the more sort of practical audit side of things, those were the key areas that I wanted to highlight this year, and I'm just going to pass now over to Hugh just for a few closing comments as well.
Thank you very much, Matt. And I think we're nearly out of time now, so I will draw the webinar to a close, but just a reminder that we will send around slides and recording after the session, as well as any answers to questions people may have raised in the chat. So just remains me to say thank you to everyone for attending. I hope you found it useful and feel a little more ready for your year end as a result of the day, and just enjoy the rest of your day. Thank you.